Welcome to the Plan Stronger TV market update for Wednesday, May 27th. A lot to talk about, so we'll dive right in. I'll go ahead and put those numbers on the screen for you. You've seen them, of course, a lot so far. The total return for 2025 for the indices that we're commenting on, and then you can see the year-to-date numbers remain strong across the board at bonds basically flat. So I want to truncate the commentary about how the particular stock indices are doing because we've got a lot to talk about, and I want to get right into it with Robert. Robert, the big thing that I want to make sure we get to on today's update is oil. You know, there's been so much going on in the Middle East, as you know, and a lot of negotiations that have been occurring. And I want to say this, there's a lot that we do not know that's been happening in terms of these negotiations. That is not reported, okay? The media does not cover it, partly because they don't know either, okay? So I think a lot is about to come to a head here, and my guess is we're gonna either get a deal done soon, and there will be, a resolution that relates to the Strait and Iran and the flow of oil, or we won't get a deal, and then we will see a much stronger action that occurs. So we could either have some resolution and an easing of the price of oil, or we could have a more conflict. And I think that next conflict will be a very, one-sided conflict, kind of a total conflict. And that then will, of course, shock or impact the price of oil upward. So with that table set, what can we share with investors to have them kind of have those things in mind and navigating their own passage through whatever straits they may have?
Well, let me start with kind of a brief history of where we were before the conflict started with oil. So a year ago, I looked at, I'm looking at the futures price during these time periods, so not the spot price, little different. So a year ago, May 27, 2025, WTI, West Texas Intermediate, was sitting at around $60 a barrel. Beginning of the year, June 1st, it was down a little bit to 57. But right before hostilities started on February 28th, it was at 67. So $67 a barrel. Now, when hostilities began, just a few days later, a week and some days later, on March 9th, oil WTI got up to almost $120 per barrel. Now, the interesting thing about that one day, March 9th, David, is that oil almost reached 120, which was its high. Its low was actually $81. So you're talking about a $38 spread between the high and the low. And then it closed at 94, just shy of 95 barrels. So basically a $25 lower than the high. So obviously a huge amount of volatility in just that one day. But right now, this morning, of course, it can change by the time our viewers are watching this, but this morning it's about 88, 89. So about $20, $21 higher than before the conflict began. But one word which, and you really hit on it with, we don't know where negotiations are going, they're secret, it's a tit for tat going back and forth, volatility. So you look at oil since, you've had that spike, but it's been up, down, up, down. A few days ago, it was above 100, David. Now we're sitting at 88. So the number one word when we're dealing with the situation we're in now is volatility.
Well, and it's not only volatility, it's not only the fact that we don't know everything that's going on, and candidly, we should not know, okay? There are things that need to be done between two parties negotiating and firming up a deal that can be enforced and that people can live with. Here's the other thing that we need to recognize. Just using the numbers that Robert talked about, and I'm going to do simple math. If the oil got up to $120 a barrel and then now it's back to high 80s, let's just call it 90. Depending on who's talking, somebody might say, well, it spiked at 120, it's back down to 90. Well, wow, look at that. That's a $30 a barrel drop. 30 on 120 is a 25% reduction. We're not hearing that. So keep in mind that there is a narrative, there is a, dare I say, a spinning or a presentation of this information, or not presenting it to you that is, part of what's going on. And that is just because that's part of, the excitement and, oh, there's problems that the media likes to talk about. So I think we have to recognize that, Robert. Now, with all that said, the thing I want to get to is, what do investors do now based on what they believe or what their expectations may be about, well, things are going to resolve or they're not, or they're going to resolve with a peace deal, or they're going to end up being resolved militarily in a more, extended way. So how do people navigate those two? I think, one may be more likely than the other, but you can't rule out the other possibility with those two potential playouts of the situation.
Yeah, so let's say oil prices remain elevated or even spike and go higher. Obviously energy companies, the oil companies, you're talking about the drilling and extraction companies, even alternative energy companies and electrification trade. The higher oil goes, the more, okay, well, let's move into these alternatives, which they show an increase in demand, which is great for those companies' stock prices as well. So those companies would do very well with energy prices, the price of oil in particular being elevated. The companies that don't do so well, transportation companies, airlines, freight costs, whether it's by air, land, or sea, though with those increased costs, less of a bottom line, the stock price gets a hit. And conversely, if there's a deal reached, Strait of Hormuz opens, oil flows. Remember, the United Arab Emirates left OPEC, so decreasing political power for OPEC and that organization. If the price of oil plummets, not just an inverse, you won't only see energy company price will come down, and we saw that yesterday. Great green in the stock market. Dow was down a little bit, but aside from that, but the energy sector was down 2 to 3%. So, again, I don't have to say don't put all your eggs in one basket, but it's an even better situation with the price of oil dropping, because aside from oil companies, transportation costs going up, but you have consumer discretionary stocks. Those are the restaurants, because the more money people can save in their pockets, the less money they have to pay at the pump, the more money they have for discretionary purposes, for other things. So you're seeing a much broader economic upturn if the price of oil plummets.
Yeah, very well put, Robert. Yeah, if you're not putting money in the vehicle on Friday after work, that money that's left over, it's time for beer and wings, right? I mean, that's what people do. And I want to underline and give an example very quickly of what Robert talked about with speaking to diversification. If you have all oil stocks and the oil goes up, those companies may be more profitable. Conversely, if things settle, those oil companies are not going to be getting as much for the oil and their profits will go down. So if you're building a portfolio or something, you want to make sure that is considered adequately if somebody's managing your money for you, and that is that there is real diversification in your stocks. For example, if you want to own Delta, okay, as an airline, well, then you might also want to own Chevron as an oil company, because as Robert said, those two are going to tend to move, inversely in opposite directions, and that's what we look for when we're building a diversified portfolio, to make sure you're not all in one area.
Yeah.
All right, final thoughts?
Final thoughts. I just want to briefly mention interest rates and the Federal Reserve. A lot of talk with oil prices high. We had some pretty nasty inflation reports, PPI, Consumer Price Index. So we saw inflation for the time being in the last few reports go higher. And that's expected with oil and energy prices, because it's such an integral part of our economy. So, and at the same time, we also have earnings coming out, and earnings have been spectacular. The AI trade has been blossoming and pushing out, affecting mid-caps, small caps, being more productive. 19% growth in earnings, phenomenal. But so we have Wall Street doing fantastic. Your 401k is doing great. But then you have the Main Street. Consumer sentiment, consumer confidence, you'll hear, they're blaring the headlines, all-time low. Inflation expectations, it's people are nervous, David, and that understandably so. But with interest rates, the narrative is, well, the economy's doing well, stocks are high, labor market is pretty good. So we might have to raise interest rates, but and this gets academic, and I don't want to get to academic, but with productivity so good and labor market strong, but Main Street kind of hurting, there is a strong case for actually a reduction in interest rates. And I think that would do very well to help companies, even the Magnificent Seven, continue the productivity boom while at the same time offering relief to the 50% of the bottom half of the population where higher borrowing costs really hurt. So, it's a complex situation, but a lot of the mainstream media is focusing on, rates should go up because of the high energy prices. Not so fast, but I'll leave it at that. But where we are now, with the new Federal Reserve Chairman, lots of moving parts, lots of things going on, and we'll keep you informed moving forward.
Yeah, and again, one final point to add to what Robert said is that always look at the data, or trust somebody that's looking at the data with your money, because there's a lot of information out there. Not all of it gets focused on. If you were just arriving on the planet and reading or watching the news for the first time, you would think that in some cases what's being reported is that interest rates are going from 3 to 10% and inflation is doing the same thing. And it's not happening that way. Yes, there are some things that are to be monitored, but as Robert said, the economy has strengthened. We're seeing some positive things. The stock market has responded, and that's the reason why we're seeing the stock market indices reaching the levels they are now, which, and again, as you looked at the numbers that we started the update with, year-to-date numbers are strong. There you have it. So, okay, so we'll wrap right there. Lots more to talk about. I promise we'll come back, share more with you, monitor the situation, and help you continue to plan stronger.